Welcome to the Infinite Wealth Podcast. I'm Cameron Christensen, along with our co-host Anthony Faso. We just wrapped up my favorite interview. We interviewed Tom Wheelwright, international tax expert, author, and entrepreneur. Anthony, great interview. What's a takeaway or two that you had?
Wow, there was so much. It's hard. Really hard to pick one. Oftentimes I feel like I say that a lot,
Yeah.
but this one there
This
was
time you
so
mean it.
much. Even like we may, this is a little longer episode, but there is some great content. Maybe it takes you 2 times to listen, but man, honestly we've been trying to get Tom on here for a while. So I was pretty pumped to get him on here, and probably my biggest takeaway was he talked about how important taxes are to building wealth and to really navigate that. There's a lot of ways that you can lower it, and to help you navigate it you need to have a CPA who really understands taxes, particularly for an investor. So that to me was probably my biggest takeaway. What was yours?
I had two big ones. One of them was I'd probably echo what you said there, is that the tax code is really an incentive for us to win. He called it a game. And if you're going to be a successful entrepreneur, successful investor, is you got to know the game. And then you got to go play the rules, right? And so play by the rules. So that is number one takeaway. The second one that I wrote down was I've heard this before, but I don't know. Today just kind of clicked a little bit more, is that he talked about the view of entrepreneurship being risky. And he gave an example of being a W-2 employee and losing your job to no fault of your own, just outside of maybe expenses, economy, right? The business owner just scaling back at times. And so that hit home for me, as I think a lot of people are in that situation, and they're actually in a very vulnerable situation in life. And so being an entrepreneur, you're much more adept at being quick and nimble and being able to be flexible with the economy and go support yourself. So I really appreciated that.
Well, and some of the things that we did talk about was, of course, we had to ask him his view on whole life. So he shares about whole life versus term. He talked about, he has a franchise called Wealthability. And so he talks about the CPAs in there. So he talks a little bit about some things that you can do to find a CPA who understands investments, but also understands real estate. We also went briefly on Robert Kiyosaki's cash flow quadrant and the different taxes in there, how he met Robert Kiyosaki, which was very, very interesting. And he talked a lot about these tax codes. It's a list of incentives, and that it can be a win-win for the taxpayer and also for the government. So if you haven't heard of Tom, you need to. And I would really check out a few of his books. His newest one is Tax-Free Wealth, that just came out with the 3rd edition. And then the one, Win-Win, the 7 tax strategies the government will pay you to make. And on there, he talks about life insurance.
Great. Hope you guys enjoyed this interview. Again, Tom Wheelwright, best-selling author, Rich Dad Advisor, international authority on taxation. He specializes in teaching how the government can actually become your biggest ally in achieving financial independence. And today he was here to make taxes fun, easy, and understandable. Hope you enjoyed this interview.
Take care.
If you're an investor or want to be an investor and you're looking to create passive income that exceeds your monthly expenses, then this is the podcast for you. Here on the Infinite Wealth Podcast, we combine the philosophies of Robert Kiyosaki's Rich Dad Poor Dad, along with Nelson Nash's infinite banking concept. Welcome to the Infinite Wealth Podcast. I'm Cameron Christensen, along with our co-host Anthony Faso. Hey guys, we are excited today. We have the author, entrepreneur, Rich Dad Advisor, Mr. Tom Wheelwright. Tom, thanks for joining us.
Hey, thanks for having me. It's great to be with you guys.
Absolutely. Tom, we've got a whole list of questions for you. You are the tax expert in the U.S., in my opinion. And so we've got a whole list set aside for you. But before we do that, is oftentimes you hear all these very specific kind of industry terms that get thrown around. Tax-free wealth, right? Here's another slogan. The rich don't pay taxes. The government incentivizes us to do certain things. Somebody needs to pay their fair share. Tom, I want to touch on a lot of those. But first, my first question to kick this off is, What does tax-free wealth mean to you?
Oh, it's really more of a tax-free life. So, taxes are the biggest drain on your wealth. They're the biggest drain on your productivity. They're the biggest drain on society. Frankly, I think they're a huge drain on society. So, tax-free wealth is really about doing things. It's actually about being a better partner with the government and doing things they want you to do in the way they want you to do them so that you can actually build more wealth. And they're happy to have you pay less tax because it's a win-win. It's very much a win-win with the government. They actually do really well. They get to invest in every single new business. The government does. They get to invest in every single new venture, and they're willing to take that risk. The amount of risk is the amount of taxes that you save. They're willing to take that risk if you're willing to put in the work. So it's actually kind of a sweet partnership for them, and if it's done right, can be a sweet partnership for the entrepreneur and the investor as well.
Now, Tom, what do you mean by partner? Like, how are
Well,
they our partner?
So look, you remember your first paycheck, right? And you got that paycheck. You go, wait a minute, I thought I was making $10 an hour. This is way less than $10 an hour. Then you looked at the pay stub and it said FICA, and you go, who the heck is this FICA guy? That's your partner. That's your partner. It's the government. We're all partners with the government. We don't get to choose whether to be a partner with the government. We do get to choose what type of partner we are with the government.
I love that approach. And honestly, that was actually kind of revolutionary for me when I read the book. When I first started my business years ago, it was a very antagonistic relationship that I had or view of the government is, man, get the heck out of my way, right? I'm trying to do all these things and you're a distraction from me kind of growing and building. And it was really your book and your perspective that you shared that really changed my point of view as far as kind of embracing the government and also the tax code. So, man, I really appreciate it. And one of the questions I have for you just to kick this thing off was, how does someone become so passionate about taxes? What's a little bit about your background?
I think it's a great game. It really probably started for me as a game. I love games. Okay. I love sports. I love games. And it's the most complicated game there is. And to me, well, the fun part about taxes is figuring out how to win the game where everybody wins, not just you, but your employees can win the game, your vendors can win the game, your customers win the game, and the government wins the game. So there's no reason there has to be, to me, there's no reason there has to be winners and losers. There's winners and losers when we cheat on our taxes, then we're winning, the government loses. There's winners and losers when the government takes our money and we don't get anything tangible for it, right? It's just coming out of our paycheck. So that's a win, that's a win-lose. But if we actually understand how the tax law works, it absolutely can be a win-win, which is why I named my second book Win-Win, because I really think that's the way it should be. And I think that's actually the way it's intended from the government. I just think most people don't understand that it could be that way.
Well, here's your book here, the Win-Win, the Win-Win Wealth Strategy, 7 investments the government will pay you to make. What do you mean by a win-win?
Well, so think about this. The government, I mean, wouldn't it be great? I mean, think about how great it would be if you could be an investor in every single enterprise ever started.
It'd be awesome.
It would be awesome, right? Yeah. Well, the government is. The government's a partner. They are an investor in every single enterprise ever started in the US. And so, then the question is, well, what do they get out of it? Well, eventually, some of those enterprises pay off big. I mean, think about private equity. Private equity is really happy if they win 2 out of 10. They're really happy if they win 2 out of 10. The government probably wins more than 2 out of 10, sure. Right? So because the government gets to invest in all of them, they don't pick and choose. As long as it's not a hobby, they're going to be an investor. And so there it's a win for them. But eventually it starts to pay off because you start making money, you're paying taxes. I mean, even take Amazon or Tesla, right? They didn't pay taxes for years, like 20 years, but now they're paying a lot of taxes. So it's a long range plan. It's a long-term investment for the government sometimes, but eventually, it can pay off really big. I mean, NVIDIA is paying off big, now to the government. Tesla pays off big to the government. Amazon pays off big to the government. Microsoft pays off big to the government. These were all startups, and the government helped fund those startups through tax benefits. And now the government's reaping the reward. So the government's just willing to do that. We just have to know how to let the government do that for us.
Tom, you mentioned something in there, and I was going to add to it is that rates, right, are often vilified. You mentioned, right, investors pay a different rate as opposed to W-2. That concept is really expanded in Kiyosaki's, I think it's third book, but Cash Flow Quadrant. Would you mind taking just a brief minute and go over that idea of quadrants and then the tax rates? And I've got a couple follow-up to that.
Well, yeah. So the very first question that you got to ask, that frankly, your CPA should be asking you, is how do you make your money? Because how do you make your money impacts what rate you pay. If you're an employee and you make a good salary, you're probably going to pay 40%. If you're self-employed and you don't know any better, so I put that caveat in there, you'll pay 60% because you're paying both the employer and the employee share. If you're a big businesses rarely pay more than 20%. And then if you're a professional investor, you really ought to be paying 0. So it's really, but that's how the law is written. That's not a loophole. That's intentional that it's written that way. Employees, I mean, if you think about, so Amazon didn't pay taxes for 20 years, but their employees did, right?
Yeah.
So their employees were paying the 40% tax, even though Amazon wasn't paying any tax. Now Amazon and the employees pay tax. So it's still a win-win in that situation. But how you make your money does have a big impact, because you can make your money. You make your money in real estate, for example, you're probably going to pay 0 tax. If you make your money in as a doctor, you're going to pay high tax.
Yeah. You mentioned the quadrants there. I've had this conversation a few times, not a lot, but I think it's worth noting here is that kind of the quadrants. A lot of people will look at the quadrants and they look at employee, self-employed, big business to investor. And a lot of people will view that on a linear kind of timeline. Like, hey, I've got to go from this to this to this. That's not really the case. Can you maybe speak to that?
Yeah, well, let's face it. Very few people will go to big business. So that's a unicorn that ends up in the big business, in the B quadrant. But anybody can become a professional investor. That's actually not that hard. So whether you're investing in single family homes or you're investing in energy, you're investing or you're a small business, right? You can be a small business. Most small businesses are just employees who own their job, right? That's the typical small business. But a small business is anything under 500 employees. So most businesses are under that definition, small businesses. But you make a lot of money in a small business. You don't have to be a big business to make a lot of money.
Tom, there's a lot to unpack there, but we have a lot of our listeners who are currently a W-2 employee, or maybe they're trying to get off of it. But there's really a couple things. One is financially making that hurdle, but also mentally and emotionally. You might want to share some words of wisdom as somebody who's on that fence, but really kind of difficulty with the mental piece?
Well, I'll tell you a story, and this is kind of how I got over it, because I was an employee for 13 years. I went to work for a Fortune 1000 company as their in-house tax advisor back in the 1990, actually. And the very first job I had, my very first responsibility was lay off half my department because they were having a massive layoff. Okay. I was actually the only person hired in the company. This is a Fortune 1000. I was the only person hired in the company in 6 months because they were about to lay off a bunch of people. So my job is to lay off all these people. And I'm going, we weren't laying them off because they were doing a bad job. We were laying them off because it was a force reduction. And I'm going, so who has more risk here? The entrepreneur who has 500 customers or the employee who has 1 customer? Every employee has a single customer. That's their boss, right? That's their single customer. That's their job. I find that very risky. People think that entrepreneurship or investing is very risky. I'm going, wait a minute. You are in the riskiest business there is. If you lose your customer, you now have to go find another customer who's willing to pay you, by the way, not a little bit, but an annual salary in order to be your customer. I find that, to me, that was a big mind shift to me, because I'm going, wait a minute, being an employee is really risky. Being an entrepreneur is a lot less risky, because if I lose a client, great. So what? There's another client, right? It's not a big deal. But if you're an employee and you lose a client, you're out of work. So I think that's the biggest mind shift people have to have, is that, people think being an entrepreneur it's risky to be in business. I think it's far riskier to be subject to somebody else's control and whims.
Tom, you're kind of the industry expert here, and one, maybe give us just a brief background out of curiosity. How'd you meet Robert Kiyosaki? And then I've got to follow.
Let's talk about risk here. So I'd
Yeah.
started my CPA firm, and we'd grown, and I'd added a partner, and then my partner and I broke up, and all the employees stayed with me, and half the clients went with him. So what that meant was that I had a lot of staff. They were well-trained staff. I didn't want to lose the staff. It's too hard to train staff. And so I went looking for more business. The easiest way to find business in my profession, CPA, is to buy a CPA firm. And so I actually got a postcard in the mail, said firms for sale. I called the number, asked about a couple of them. And one of them sounded really good, because they did a lot of tax consulting with entrepreneurs. It turned out that one of the clients was Robert Kiyosaki. I had no idea who he was. I'd never heard of Rich Dad Poor Dad. Actually, the first thing I had to do, the seller said, the first thing you have to do is you have to read Rich Dad Poor Dad, because he's kind of a big deal. This was back in 2001. So I did. I'm going, okay, well, this is interesting. I mean, I'd grown up with, my dad was an entrepreneur. My grandfather was an entrepreneur. So to me, Rich Dad Poor Dad is, well, duh. That's how it works. I mean, it wasn't this big life-changing thing. When I read Rich Dad Poor Dad, I'm going, well, yeah, doesn't everybody think that way? And it was cool to do that. But then Robert and I got to know each other, over the years. And then, I do remember, though, being on stage with him at the Paris in Las Vegas, and it was my turn to be up, and I was talking about how the tax law is a series of incentives, and he looked for entrepreneurs and investors. He looks at me and goes, "Really?" And it's like the light bulb went off. And after that, I was traveling all over the world with him. So it's actually been a really great relationship. He's a great mentor, and we share a lot of ideas, and we learn from each other. And it's been fun. He's an interesting guy.
I bet.
I have to imagine, Tom, that's got to go down one of your best investments, buying that CPA firm.
And that's the thing. But my point of that story is you just don't know, right? Of course it was, but I didn't know that at the time. Yeah. I was actually trying to serve entrepreneurs. I was serving entrepreneurs. I wanted to give entrepreneurs the best tax advice that they could get. And the result was I opened myself up to Robert Kiyosaki. Had I instead let half the staff go, I'd have never met Robert Kiyosaki.
Well, I would say that's an example of kind of an abundance mindset versus a scarcity mindset. You talked about the title of your book being win-win, right? There's two ways you approach that scenario. One is you cut staff, or two is you go out and find more business. So that's a testament to that.
You'd mentioned that the tax code is a book of incentives. I thought it was just more of ways for us to pay more tax. Can you expand on that?
Well, yeah. So think about it this way. So there's one line in the tax law that says all income's taxable unless we say it isn't. There's another line that says no expenses are deductible unless we say they are. There's some charts and tables tell you how much tax to pay, but 99.9% of the tax law is a roadmap to reducing taxes and building wealth. If it wasn't about tax reduction, you wouldn't need 6,000 pages. You might need 500. but you wouldn't need 6,000 pages. Most of the tax law, what's interesting to me is that the tax law is actually, it's pretty clever. I mean, you take, for example, a business deduction, which I always tell people that ask me is if something's deductible, could we ask a better question? And that's, how do I make it deductible? Better questions produce better answers, as you know. And, but the rules to become a business deduction are the same rules that you should apply in your everyday business. You shouldn't have an expense that doesn't have a business purpose. You shouldn't have one that's not ordinary or necessary, and you shouldn't have one that's not documented. Those are the 4 rules for a business expense. Well, as a deduction. Well, those are really the 4 primary rules for whether you should spend the money in the first place. Right. So it's actually a pretty good guide on how to run a business.
Tom, you mentioned something a minute ago that was kind of a light bulb for Robert when you were up on stage talking. A light bulb I had when I was reading your book was that your approach to taxes is almost opposite of everybody else. And what I mean by that, my experience with CPAs, Anthony being one of them, I'm surprised he hasn't said he's a recovering CPA at least 3 times yet.
I don't need to. He will tell everybody for me.
But where I'm going with this is that a lot of accountants are very short-sighted, right? And so what they're looking at is they're looking at very deductions this year. They're looking to minimize somebody's tax liability solely now today, and they don't kind of have a long-term vision. And reading your books, I'm going to state it this way. This was my takeaway: is that you start with the end in mind. And you try to use the accounts and the vehicles that are available to us to get to where you want to go. Often that's not the case. Why is your approach so much more different than everyone else?
Well, I just decided to take a positive approach to a negative subject. That's all.
Okay.
That's basically it. And it's not just accountants. You know, I hear all these wannabe tax advisors out there who are constantly talking about tricks and tips. Right. Yeah. Here's a way to trick the government. Here's what the wealthy do. I'm going, no, the wealthy hire really smart, well-educated tax advisors. That's what the wealthy do. Okay. They're not using tricks and tips. They're not using loopholes, which are unintended consequences. They're actually following the law. And the IRS recently just did this huge program to audit wealthy people. And what they found is that wealthy people cheat less than half as much as non-wealthy people. That's what they found. Those were the findings. They had less than half the adjustments on their tax return. Well, that's because they have better advisors. I don't think it's just CPAs. I think it's your EAs and the other people who hold themselves out as tax advisors. What they're doing is they're saying, well, here's how to pay less tax and really kind of cheat the government and do it legally. I'm going, no, why don't we just do something that actually is a win for the government, do it the way they want it to be done, but do it in such a way, if you do it right and you do it the way they want you to do it, then you should pay less tax, because the government said you have 2 choices. We don't care which one you take. You can pay high tax, or you can pay low tax and invest the way we want you to invest, but you get to choose. And I just took the approach, you know what, let's look at, first of all, let's make it simple, right? Because I don't think conceptually the tax law is that hard. It really is those 2 lines and then it's a roadmap. I mean, other than that, the details are difficult, but that's why you hire people like me and my franchisees, is because the details are complex and you need to actually have the education in order to do it. But you also have to have the mindset to do it. You have to understand that to me, a tax advisor is the primary advocate for their client. They're the primary advocate with the government. And if you're not an advocate for your client, then I'm not sure why the client wants you for their advisor. Because I don't know about you. I like having advocates on my side.
Well, you had mentioned about some different win-win strategies. One, you'd mentioned energy. That's something we haven't discussed a little bit. You mind giving us a little overview of some of the tax savings with energy?
Oh yeah. So energy is the big deal right now. I mean, think about what the government wants done, right? They want jobs, they want technology, they want food, they want energy, they want they want housing, right? So those are the things the government incentivizes. They want savings, right? Savings. That's by the way, savings comes down to life insurance. You know, they want you to have money when you die, so your wife doesn't, or your husband doesn't have nothing and has to rely on the government. That's life insurance. And then you have the retirement plan, so that you don't have to rely on Social Security alone. When you retire, you actually have some retirement savings. But energy is a big one, because the world runs on energy. The country runs on energy, and our Constitution says that we have property rights, right? So the government doesn't own the energy like some countries. Some countries, the government owns the energy. They own the mineral rights. They own the land, right? But in the U.S., individuals own the land and the energy underneath it. So whether it's fossil fuels or whether it's renewable energy, the government gives big incentives. I mean, right now, of course, the biggest incentives are for renewables, because we had that huge blowout in 2022, the so-called Inflation Reduction Act, which is really hard for me to say because it did the opposite. But that was a huge blowout in spending and incentives for solar energy, wind energy, even nuclear energy. And so basically they're looking at renewable energy sources. And so there's huge incentives, both tax credits and tax deductions. In the fossil fuel side, there's still huge tax deductions. For example, you can invest $10,000 in an oil well development and get the very first year, get an $8,000 to $9,000 deduction. Well, and in fact, you don't have to have any, you don't have to be active in that at all. You can be completely passive. It's actually the only activity where you can invest, get a deduction for almost the full amount of your investment, and not have to be actively involved in it.
That's crazy. Speaking on oil and gas, Tom, we kind of discussed this before. We'd love to have you back and go a little bit more in depth on that. You mentioned that, what'd you do? Your master's down in Texas? Is that what you did?
I'd love to. Yeah, I did a master's degree in Texas, and then I started my career in Utah, where during the gas boom days of the 1980s. And so I've spent some serious time in the oil and gas area. When I was actually in the National Tax Office for Ernst & Young, one of the partners I worked for was the oil and gas expert. So I've got a little bit of background there, and I've been an investor myself.
Excellent. No, we look to have you back, because one of the two big issues that we talked about that before, one was finding somebody reputable, and then two was trying to get some money back on that return. And so you're going to tell us how to do that next time when we come back here. But
you got it.
Today, one of the questions I had for you was, you'd referenced kind of gimmicks, and on social media, you see all these kind of taglines. We're in the infinite banking space, which is around life insurance. And that's one of the things I've seen a ton of social media touching on. Tom, is life insurance and cash value, is that a gimmick, or what's the real deal?
It's not a gimmick. And the way I like to explain it is you have term insurance and you have permanent insurance. And term insurance, pretty much, the statistics I think are less than 1% is collected. So basically, term insurance is just an expense. And is it a necessary expense? Yeah, absolutely. Everybody should have life insurance. But permanent insurance, whether it's whole life or universal life, however you want to do your permanent insurance, that's an asset, because over 97% gets paid out. So to me, it's just a question: do you want an expense or do you want an asset? An asset is something that produces income over and over again. An expense should produce income, but the problem with the term insurance is, and of course, the idea is, you have the lesser term insurance, then you invest the difference, but nobody actually invests the difference, right? Yeah. That's the problem. And so with like whole life, and I have a whole life policy, it's nice, safe money, and you have a lot of access to it. If you decide to use it as collateral for borrowing, you can do it, which is the whole idea of infinite banking. But you can borrow, and you're not borrowing it out like you are in a 401k. And because of that, if you use it for investing, you actually get a potential tax deduction for the interest expense you're paying back the insurance company, because you're not paying yourself, you're paying the insurance company. So it's kind of I think it took me a long time to understand it, frankly. But once I understood just expense versus asset, then I got it.
I'm sure it probably didn't take you. It took Cameron a little longer to understand it, but he came around as well.
Uh, Tom, another thing that I often hear on social media, right? And I want your opinion on this is you said it took you a long time to come around, but um, you often hear people when they're promoting life insurance that, hey, this is the way that the wealthy people do it. You're very established in this space. Are wealthy families using insurance as kind of a
Oh,
storehouse of wealth?
yeah, yeah, of course they do. I mean, it's a safe asset. I mean, you've got to have some safety in your assets, and whether that's, some people use gold and silver for that. Other people use real estate for that, and those are both safe. But the nice thing about life insurance is liquid, and
Yeah.
so it's a safe asset that's easily liquid. It's easily portable. Gold and silver, they're heavy, right? It's actually not easy to convert at the current market rate. Whereas life insurance, the life insurance companies are required to lend you the money. I mean, it's in the contract. So it's actually to me, it's like having a line of credit. I think everybody should have a line of credit on their house, right? Because it's right there. It's available. If you need it, you can use it. To me, life and whole life is a lot the same way, and especially if you're putting away a few $1,000s a month, it's hard to get a whole lot of return on that. And so life insurance makes a lot of sense. I just think it's in that safe category. It's a safe liquid asset that actually has a return on it. And there just aren't a lot of categories like that.
In the book, you mentioned kind of along the same lines as far as kind of leveraging it, right? And pairing it with some sort of asset class. What's your thoughts on that?
Well, it's so I'm going to use my cash first, because cash it's cheaper to use the cash, right? But I like, again, I like having it available. To me, it's like a line of credit. It's very much line of credit. It's just your own line, right? But you are paying the insurance company, so it is actually a line of credit. While your money keeps earning inside, because you're not actually taking the life insurance out, the cash surrender value out. It's you are paying the life insurance company, so it's not free money by any means. It's not free, but as a way to leverage, I think it can be. I think it's judiciously used, it can absolutely be terrific. I like having, frankly, one of the things I like about whole life is I like the idea of being able to spend myself into the ground when I die, and then but I don't have to worry about the people I leave behind because there's life insurance for them, right? And I know it's permanent, so I know they're going to have it. But I do like I like options. Okay, I'm the youngest of 6 children. I like options, and so to me, whole life especially gives you just a lot of options.
Also, in your books, you talked about a concept or strategy called buy, borrow, die,
Yeah.
which is kind of along the similar lines. If you mind expanding on that for our listeners?
Well, yeah. So the idea is, you buy assets, right? I mean, Kiyosaki says an asset is something that puts money in your pocket. So, and the rich don't work for money; they work for assets. So you buy assets, and then what you do is instead of selling those assets, you re-leverage them. So as they go and go up in value, this is where real estate is particularly useful, and life insurance too, by the way, because they're both very easy to leverage. Right. Life insurance and real estate are probably the two most leverageable assets you've got. And so then you can actually borrow the money out. You don't pay tax when you borrow. Okay. Eventually, when you die, all the tax benefits you've gotten, you don't have to pay them back, because all that goes away. And life insurance is, of course, you guys are the experts on this, but life insurance is one of those few ways to get cash without paying tax. And it's pretty easy to set it up so you don't pay income tax or estate tax. And that's just not that difficult. Lots of uses for life insurance, but one of them certainly is it's an available form of leverage. So you can buy it, you can borrow, you can use it to borrow, and then when you die, you don't pay any tax on it.
We were talking earlier about kind of the government incentivizing us to do certain things. And in your book, you talked about life insurance, but the government's incentive to kind of provide that for us. And I thought it was really interesting. You had talked about the government is actually benefiting from life insurance. One of the things you often hear out there is that the government, it's just a matter of time before they come after kind of the tax-free buildup on cash value.
Mm.
But in your book, you reference, what I thought was an interesting piece. Do you know what I'm referring to?
Yeah, it's chapter 7 of the Win-Win Wealth Strategy. Yeah, I do. I think that actually there's only one of the 7 investments that the government doesn't win on, and that's retirement plans. So retirement plans, they break even. But life insurance, remember that the amount you put into the life insurance plan is not deductible. So you're paying tax, right? It's like a Roth IRA, right? You're paying tax on the money. You don't get a deduction for your putting your money in. And so, yeah, it's building up in there. And if you were ever to get rid of your policy, you would pay tax, right? I mean, it'd be like pulling it out of an IRA. You would pay tax on the earnings, just like you would if you pulled money out of a Roth IRA before you retired. So, so the government, I think the government wins though, because there's such a social need for having, really the idea is widows and orphans when it comes down to it. But it's also, but remember, it also protects, like I have, one of the reasons I have whole life is because I have a commercial building, I have a loan on it, and I don't want to saddle my family with a commercial debt when I die. Well, the life insurance can pay that off. So, it really is just that safety net. I think the government really does want us to have that kind of a safety net. And so that I don't see that ever changing.
Tom, I think everybody knows you kind of as Robert Kiyosaki's CPA is kind of one of the things that have brought you to in the public. Plus, like your book, Tax-Free Wealth, which just came up with the 3rd edition. What made you come up? I know this book sold well. I'm sure if it's on the 3rd edition. Curious, what's in the new one, and what made you want to update it?
Well, so it turns out about every 5 years there are enough major tax law changes that you have to update a book like Tax-Free Wealth. The 2nd edition came out just after the 2017 tax law. So it had to incorporate the 2017 Act. But in the last 5 years, since 2017, that's 7 years, right? So since then, we've had 6 major tax law changes. So during COVID, we had a ton of tax law changes. And since then, we had the Inflation Reduction Act. We had Secure 1.0, we had Secure 2.0, which were retirement acts. So we had a lot of tax changes, and so it needed to be updated to reflect all of those tax law changes.
Speaking of changes, what do you anticipate here moving forward?
Oh my heavens! So brace yourself for 2025. You're gonna you put that seatbelt on, put the shoulder harness on, strap in tight, because we're in for a wild ride in 2025. I heard a Democratic senator call it 2025 was going to be tax Armageddon. And just to give you a reference point, so the difference between the Democrats' plan and the Republicans' plan is $7 trillion with a T. We've actually heard 7 trillion different. So the Republicans want to reduce taxes by 2 trillion. The Democrats want to increase taxes by 5 trillion. And if you somehow think that 5 trillion isn't going to come back to you just because it's the whole tax the rich thing, you're crazy. First of all, the biggest revenue raiser in there is raising the corporate tax, which, by the way, affects everybody with an IRA, 401k, pension plan, profit sharing plan. Everybody with an ETF or a 401k, whatever, they're gonna, that hurts them, right? And that's more than a third of the market. So everybody gets taxed. Nobody goes unscathed with a major tax increase. Either way, though, the 2017 law runs out in 2025 for the most part, with a couple of exceptions. And so something's going to have to be done. Otherwise, there's going to be major tax law changes if nothing's done, because individual rates go back up. We get alternative minimum tax back. We get the tax for small businesses goes up by 25%. If nothing's done. Also, all sorts of major changes if nothing's done. So no matter what, there are going to be major changes sometime in 2025, or hopefully in 2025, and we won't have to wait till 2026.
They're always talking about taxing, right?
Yeah.
But you know what I think, and that bugs me for many reasons. For one, it ends up it divides us, like the rich and the poor, or
Yeah.
you get that tax break, we don't. But you know what nobody's talking about is about the spending.
Yeah.
I mean, there's one thing if the rich don't pay enough tax, but you know what? If we could just curb all the spending, I think a lot of this would these deficits would go away. Sorry,
It's interesting though, because I actually did a podcast on this the other day, and had a podcast interview. People tend to vote for spending increases. They don't connect spending increases with inflation. They don't connect spending increases with higher taxes. They like free money, right? I mean, especially during COVID, people thought, wow, free money, this is great.
Yeah.
I love it. Why not? And it didn't matter if you were an employee or a business owner. I mean, everybody got free money. We all got it during COVID. And we're going, wow, this is good stuff. We want more of it. Of course, then we got 10% inflation. We go, wow, where'd this come from? Well, maybe from all the free money, right? Too much money chasing too few goods is the definition of inflationary pressure. So I agree. I agree with you that we don't pay enough attention to the deficit. Now, here's an interesting one. So President Biden's his proposal is $5 trillion increase. His proposal is to reduce the deficit by $500 billion. So that means there's so that means there's $4.5 trillion of new spending, not to pay off the deficit, but just new spending. Of course, that won't cause inflation. So I'm like, it's just like politicians seem so disconnected from, the real world, but that's the world we live in.
No, I mean, honestly, I know time's rushing, but
I've got a question. You think about yours. Yeah, you need all the time.
no, I'm gonna wrap
Tom,
up here.
Well, you know why? Because you know what CPA stands for, right?
What?
Cheapest people in America.
Thanks, Tom. I'm so glad you said that. That's going to be our leading piece right there.
There you go.
Tom, man, the thought I had that I was going to share and get your input on this, man, is I just hear increased spending, increased taxes, right? Taxes going up, up, up. I look at tax rates. I feel like we're in one of the lowest tax rate environments we've ever been in, and I feel like it's only going up. Deferral to me personally has never made sense. Maybe you can share your thoughts on that.
Yeah, no, I agree. I mean, we are in well, when you consider all the opportunities to reduce your taxes so you're not in that highest tax bracket. I mean, remember under Ronald Reagan, we were our tax rates were way lower than they are now, but we didn't have as many tax deduction and tax credit opportunities we have now. And then you remember under like FDR, tax rates went up over 90%, but there were deductions out the wazoo. Nobody paid those taxes because there were so many offsets to it. So, the reality is, if you look at the numbers, capital gains need to be under 25%, and ordinary income rates need to be 40% or less. That's the reality. If your income tax rates get much over 40%, then people start doing things just for tax purposes. If your capital gains rates get over 25%, then what happens is people stop selling. They'll stop selling their assets because they don't want to pay the capital gains rate. So it actually reduces revenue. So there are some basic principles that they do understand. The tax writers actually understand a lot of these basic principles, but the politicians tend to override the people who understand reality.
Tom, I think you've got, I know you've got a knack of taking something that's very complex and taking it all the way down to something basic that even Anthony can understand. Where else, if somebody's out there, right, this isn't like a, hey, do it yourself. This isn't something where you can read one of your books and go do it on your own. what is kind of a next step for somebody that's listening that thinks, man, I need some help here. Where should they go? What can they do?
Well, so chapter 23 of Tax Free Wealth actually tells you how to find a good tax advisor. So it's a whole chapter on it. It is the most important, financially, probably the most important person in your life outside of your spouse. Financially is your tax advisor. So that is one way to do it. We actually have a franchise of CPA based tax advisors, and you can go to wealthability.com and we're happy to hook you up with, what we're happy to refer one to you. So it's really, you can find one yourself. Certainly a referral from somebody who really likes their tax advisor is a really good way to do it. But if you need a referral, I can give you a referral to our CPA franchise.
Tom, what makes the CPA's part of Wealthability different than maybe the CPA we have or our uncle or brother who does taxes?
Well, hopefully it's their training. So that's my job. My job is to train them. And actually what I was telling a group on Friday is that, my profession is teaching. That's my profession. My topic is tax, but my profession is teaching. And so we train weekly with our CPAs. We get deep into the Internal Revenue Code. We read all that stuff that nobody wants to read. And then what I do is I help them connect the dots, because CPAs are very good at following a system. We have a really good system. They're not really good at coming up with all the new ideas, as you know. Not really the forte of the typical CPA, but what we're good at is creating the system that they can follow. And the system we created is pretty much, it's, as long as they follow the system, it's infallible. It's just making sure everybody follows the system. The other thing to remember, though, is that I can't change your tax, and no advisor can change your tax. You're the only ones who can change your tax. So what I always say, as I said in Tax Free Wealth, is if you want to change your tax, you have to change your facts. And I can't change your facts. I can just tell you what facts to change. But a good advisor will tell you what facts to change, and then we'll report them properly on the tax return, because that's where the rubber meets the road, is with the tax return.
Tom, you mentioned Wealthability and kind of the franchise model. When I think of franchises, I think of cookie cutter. Every single one is the same. I don't believe that is Wealthability, right? Is there an opportunity there for somebody that comes in brand new, right, just getting into real estate, or if somebody comes in with some very complex returns, is there a spot for everyone?
That's actually why we went to this model. We had a big firm, and my partner and I had a big firm. And what we found was there was only a certain level of entrepreneur we could take, or investor we could take. And I was actually begged by one of my clients who is in the real estate space. And he said, couldn't you please, isn't there a way that we could have multiple levels of advisors? And I'm going, well, yeah, but we'd have to have a bunch of different firms. And so we actually tried it as a network, and it worked until it didn't. But with a franchise, what we're able to do is the systems and the quality control are that much better. And so that's the advantage we have with the franchise. Everybody can use the same system. It's just that they need somebody at a different level of experience, different level of knowledge, and frankly, a different pricing level. Somebody who's just starting out doesn't need the same amount of work as somebody who has 5 businesses and 3,000 doors, right? That they're two different people. So we have CPAs in our franchise that specialize in the really high end, and we have those who specialize in the brand new entrepreneur and everything in between.
Great. We've had several clients that we've sent over. We work with some of the CPAs in Wealthability, and to my knowledge, everyone has been extremely happy.
That's awesome. Thank you.
So well done training those guys up. They're performing well for you.
Good. Glad to hear it. It's all about clients. So just so you know, that is really what we emphasize. It's all about the clients. Clients come first. The CPAs come second.
I like that. Even better. Tom, we've got wealthability.com. If somebody, as a resource for you, if somebody goes there, what are they going to find?
They're going to find an easy way to get a free consultation if they want that. If they'd like a little more than that, we'll actually do an in-depth analysis of their tax return. That comes with a fee. The free consultation comes with no fee. But we're happy to just however we can serve you, we want to serve you. And there's lots of education there as well.
Great. Tom, thanks so much. Really appreciate you coming on today.
Hey, thank you. Anytime.
Thanks, Tom. Go make it a fantastic day.
Take care.
If you like this video, I know you're like this one. And if you want to learn how investors use infinite banking to increase their returns and lower their taxes, check this out. And if you have some questions and want to see if infinite banking is for you, hop on a discovery call with us. Link for that will be in the description.